Joining us more now is Kerry Craig from JPMorgan. Kerry, great to catch up with you again. Let's first take a look at what's playing out globally at the moment. Geopolitical risks rising, it would seem, particularly what we're seeing in France, also South Korea. Is that likely to have a demonstrable effect for investors, do you think?
Well, I think it's definitely something they should be aware of, Andrew, and something that we're more conscious of in terms of particularly how it affects pricing of government debt. So, a lot of the concerns this year have been around rising levels of deficits, rising levels of debt, particularly in the US, how sustainable that is. But I think we're also seeing this shift when it comes to Europe or in other markets about just the political instability, given some of the austerity that's been in place for a number of years now. And again, the government's having to deal with the ramifications of that and populations that are generally quite unhappy with the status quo. That does mean we think about pricing in more of that political risk when it comes to thinking about where yields may settle and particularly how steep yields curves may become. But more broadly, it's not something we see as being a persistent threat when it comes to the investment landscape for the year ahead. It's always something that bubbles in the background. I think it's just a case of investors having to be a little bit more conscious of some of the policy risks that we could see this year.
And of course, that is also the case as we head towards mid-January with the inauguration of Donald Trump to get some greater detail on the policies that he'll impose. More immediately, though, the focus is on the Fed. And in fact, we've just heard from Jerome Powell overnight saying the US economy is in very good shape and they can afford to be a little more cautious. What's the outlook, do you think, for rates then?
Well, I think Jerome Powell is right. The GDP figures that came in for the third quarter in the US were, remarkably strong, 2.8% annualized quarter on quarter. We've seen a labour market that's proving to be quite resilient. We've seen US consumption that's proving to be quite resilient. And so the economy does look like it's in a position of quite good health as we've entered into this easing cycle in the US. On top of that, given some of that uncertainty around the direction of the policy outlook, whether it's trade or migration, deregulation, or even some of the other policy initiatives you might see through the Republican administration, the Federal Reserve may take a slightly more cautious outlook. They are, again, Jerome Powell didn't give too much away, being very data dependent, saying they want to see the labour market report this week. They want to see the inflation numbers that come out for November ahead of their December meeting before they make that change. But I think they're trying to keep themselves flexible in terms of whether they do want to pause on rate hikes in December before continuing later on. Our view is they're more likely to cut rate in December. I think they're very happy with the direction of inflation, that it is coming down, and that they can continue to ease policy on that regard. And once they do get closer to those policy changes becoming a little bit more firm, it may be more difficult for them to have to adjust policy early in 2025. So the option is to actually get ahead of that change in government in the US. But by and large, I think the biggest risk now is that we see just fewer rate cuts come through in 2025, and it will be closely watching that dot plot and the statement of economic projections the Fed puts out in December to see how the committee is thinking about the number of rate cuts they see happening through 2025, which I expect will be fewer or have a much wider range around that, given the uncertainty of both the growth and inflation profile that could manifest over the coming months.
So, Kerry, of course, the question for investors as to whether that momentum we've seen is likely to continue into 2025. Off the back of the Trump trade, we're seeing something of a Santa Claus rally play out at the moment. What are your thoughts, particularly, I guess, if we start on Wall Street, of what we're seeing there at the moment?
Yeah, I think more broadly, we're looking at global economy, which is continuing to expand. Obviously, that growth has been driven by the US now. So that sort of idea around convergence growth, I think, in the global economy has kind of been put back, and now it's more a bit of a divergence in growth story with the US leading the pack. Obviously, a bit of trouble when it comes to the Chinese outlook. Europe very much going and slowing down and facing those political considerations. So it is supportive of the global economy, which is supportive of risk assets and equities and credit. And by and large, as we see inflation moderate as well, that should be still quite good for fixed income. So the outlook for investing is actually pretty decent for 2025, given that we do have the wind at our back when it comes to the economic outlook. The challenge is obviously valuations, given some markets are trading at pretty high multiples when we look at the equity side of things, and particularly the US. So that means we need to focus on that earnings growth, and that is looking still very respectable. It has been driven by some of the mega cap names, but we are slowly seeing that start to broaden out to the rest of the 494 names in the US market. So I think there is definitely opportunities across different sectors when it comes to the US. and also thinking about different market cap sizes, so moving a little bit more into the space as well. But it is more of a US-centric story when it comes to that outlook, a little bit less so when it comes to Europe, a little bit less so when it comes to emerging markets, given that challenge from trade, but still a good positioning for thinking about having risk in a portfolio in 2025.
So, Kerry, then what's your view on Australia? And let's first take a look at the macro backdrop, if you like. In fact, we just had those growth figures for the September quarter, weaker than expected. What are your expectations for next year in terms of the economy?
I think the GDP numbers were a little bit softer than expected. I mean, they 0.8 rather than 1 was the year-on-year growth rate. But again, the drivers of the growth are a little bit different. And I think there was a bit of a misinterpretation about that when it comes to what's driving the economy versus public versus private. And I do think there is still a decent amount of household consumption coming through. There was some distorting effects from where those energy subsidies were allocated to the government this time rather to households. And if we kind of reverse that, you'd actually see a bit of a pickup in household consumption. And there is that impact of those subsidies having a bit more positive impact. Take into account the sort of wage increases that we have seen come through in the last 12 months, even if it's slowing down, the fact that inflation is lower, real household spending or should increase as real household incomes go up. And they will be looking forward to seeing some easing of monetary policy over the course of 2025. All that for me just supports more household consumption in the economy. And we do have, relative to other economies around the world, a pretty good fiscal starting point with the ability for a government to expand to offset weakness in growth. So I would expect to see the economy start to improve over the course of 2025. But that growth is not going to be blockbuster. We're still looking for pretty sub-trend growth, moving towards 2% on a year-on-year basis over the coming 12 months. What does that mean for equities? I mean, it does continue to support the outlook for Australian equities when it comes to the earnings. The challenge is those earnings expectations are only running at about 5%, which is pretty low considering what earnings growth is doing elsewhere. And also just considering the valuations on the Australian equity market at the moment are looking at pretty elevated, obviously driven by the banks more than anything else. But it does mean that we do need to see much stronger earnings growth to really bring that multiple down. And so the risk is that you see a derating in Australia rather than a re-rating, and the index actually comes down rather than moves up relative to the rest of the world. So for us, it would still be a case of looking global, given some of the challenges in both the economic outlook, but more importantly, in the valuations of the market here in Australia. So it does look a little bit more of a headwind relative to other markets around the world.
And sectorally, I mean, talking about those valuations with the banks, what are you seeing in the materials sector at the moment? I guess particularly with the prospect that we're going to see tariffs imposed on China, or more so, and the effect that's going to have on Australia. How are you viewing commodities at the moment?
Yeah, it's more of a second round effect, I think, that when it comes to this outlook for growth. I don't think there'll be a major first round effect. I don't expect tariffs to be applied to the Australian market from the US. So it comes through that sentiment effect of will you see slower growth in the region and slowing demand for commodities. The Australian commodity production is relatively capacity contained. You can dig a lot of it up, but you still have to get out of the country, and that's where the constraints come through. So I wouldn't expect it to have a huge impact when it comes to the outlook for commodity prices. I think that that's already been reflected. Neither do we see a stimulus package from China really being focused on infrastructure build out or property build out, which would create that demand for steel and iron ore flowing through that way. So I think when it comes to valuations, obviously the miners look a little bit more attractive. You could see some value created there. And that would be a preference for us relative to, say, the banks looking towards those mining stocks. However, because we don't have that huge upside view of thinking around China stimulus coming through, there's very little to see a massive support to increasing in prices and commodities. And I think that'll still be a headwind. And overall, that sentiment impact of trade and what the growth outlook means for Australia, if China does slow, if there is slow regional growth, will be a headwind to foreign investors as well. The only offsetting factor is that I think in the region, given Australia as a high income player, it may be seen as slightly defensive in some regards. So that could offset that overall. But I think for international investors, they still view Australia as something that's very sensitive to China. And it's that sentiment effect that will really dictate how the market performs.